welcome to the Portfolio Manager. I'm your host Niraj Shah, and our guest today is Anish Tawakley. He's Deputy CIO, ICICI Prudential AMC. Anish, so good having you. Thanks for taking the time out.
Thank you, Niraj, for having me. It's a pleasure.
The pleasure is entirely ours. Anish, just at the onset, for a lot of people, because we're talking for the first time on air, would you just tell us what kind of an investment approach do you subscribe to or bring to the table when you are thinking about investing or building out a portfolio?
So our approach is, I think there are two fundamental principles. One is that we use both a top-down and a bottom-up approach to portfolio construction, which means we look at economic cycles when we are investing. That's the top-down perspective. And bottom-up, we look at stock selection. We say we look at companies that have strong competitive positions in structurally attractive industries. Right? That's the summary. A strong competitive position is evidenced by good, it should be amongst the market leaders. It should have a demonstrated track record of profitability, and ideally it should have room to grow. That's how we look at the stock selection aspect of it when we are screening companies. And if we get them, that's
yeah, sorry, you were saying even if you get them at good valuations, then that's sone pe suhaga, so to say?
Yes.
Okay, and I'm going to talk to you in detail about your business cycle fund because it's an interesting concept. But before I do that, can I just ask you that in a market which is, let's say, trading at whatever levels of valuations, FY25 or 26, between 20 to 24, depending on your earnings estimates, even if you find companies on a bottom-up basis which are going to do, which is earnings growth, etc., so on and so forth, do you find enough opportunities to build a large portfolio at good valuations currently?
So actually, we are more comfortable with valuations in the large cap space than we are in the mid and small cap space. In the large cap space, our view is that while valuations might be slightly on the richer side, they're not outrageously rich. And if earnings growth comes through, which means essentially if the economy does well, and if earnings growth comes through, and if you stay invested for a 2 or 3 year period, you should still be okay, right? So large caps, I'm not too worried about valuations, provided the economy delivers. Small and mid cap space is more challenging.
Got it. Okay. And within this landscape, let's talk about this ICICI Pru Business Cycle Fund, because it kind of subscribed to what you told me, that it aims to make the most of the evolving economic and market environment. Can you explain this in detail? What kind of fund is this? What kind of investors, whether it's mutual fund or people subscribing to this theory, what's the kind of investors that should look for a fund like this? And how would you believe the returns for a fund like this could be over a 3 to 5 year period? Would it be lumpy in nature? Would it be steady state in nature? Give us some idea about this.
So let me first describe what we are trying to do in this fund. See, our view is that the economies go through cycles. Cycles last 3 to 5 years. And what do we mean when we say economies go through cycles? We are saying, look, there are periods of booms and there are periods of slumps. A slump is when you have spare capacity. A boom is when you have demand that exceeds capacity. Now, when you're in a slump, obviously you have excess capacity, so you will not be doing much capex. You've built excess capacity, so you'll probably not be you have excess capacity, so you will not be hiring, so wage growth will be low, and discretionary consumption will be low. Whereas when you're in a boom, the economy is at full capacity, so people are doing capex, people are hiring more workers. When people are hiring more workers, they're also giving wage hikes. So discretionary spending is also good. The point being that depending on where you are in the economic cycle, different set of sectors do well. In a boom, the sectors that would do well are cyclical sectors like industrial and capital goods, cement, automobiles, also financials. In a slump, the sectors that would do well would be a different set of sectors. So this fund essentially aims to pick sectors, right? So it's a sector picking fund based on where we are in the domestic cycle and where things might be in the global cycle. The US economy or the Chinese economy also go through cycles. So these sectors will pick stocks based on where the cycles are both domestically and globally. So coming to what kind of investors is this appropriate for? See, we find a lot of interest amongst investors for sector funds. The challenge with sector funds we find is often that people get in, but then they don't get out at the right time. Or they may get in when the sector is too hot, right? It's already the bulk of the returns have been made. What we are saying here is look, we'll do the job of sector selection for you, right? So we'll pick the handful of sectors, the few sectors that we think are most appropriate based on where the economic cycle is. So people who like to invest in sector funds should go for it. It is amongst our portfolio of funds. Yes, this does have higher deviations than some of our other more conservative equity funds, but it's still reasonably diversified. So it's not a very high risk fund, but yeah, it's not the most conservative fund in the equity portfolio that we have.
Got it.
And I can't talk to you about that's not allowed as per compliance guidelines. So I wouldn't want to venture on how returns would look like
Okay.
the next.
Fair call. But here's my question then. I read your the presentation for the fund, in which I presume for equities at large, your view is that for the decade maybe, is that the higher interest rates and elevated equity valuations may result in volatility. Now, within such a landscape, how does a business cycle fund go about making its investment decisions? What kind of themes, domestic volatility, global volatility, domestic valuation, global valuation, what kind of themes does a fund like this therefore cater to?
Right. So at the moment, and I think we started on this about 2 years back, right? We started feeling that look, the Indian domestic economy will start recovering. In the middle of COVID, we felt there was spare capacity, but demand was recovering. What made us come to that point of view was we saw that real estate activity was picking up. People had started buying homes again. When people start buying homes, first the inventory gets cleared and the new home construction start, and that is a trigger for a virtuous cycle, right? Construction creates jobs. When people have homes, they also buy durable goods because demand for durable goods depends on the size of your house. If you have a larger house, you'll buy more electrical fittings, etc. So we felt, look, that was the start of a cycle. The second factor we saw was that the central bank, monetary and fiscal, actually not just the central bank, but both monetary and fiscal policy were supportive of demand creation, right? So while demand at that time, 2 years back, was weak, monetary policy was supporting demand generation, as was fiscal policy. So we felt, look, we have an economy with spare capacity, demand is picking up, policy environment is favorable. So we said, look, this is the environment that creates demand for domestic, creates the right environment for domestic cyclicals. So these are sectors like cement, real estate, industrial capital goods, because people will start adding capacities. Capital goods, obviously, once people have incomes, demand for automobiles, etc., would also rise. So if you look at the portfolio, the last published portfolio, you will see that skew in the portfolio. You would see automobiles being pretty heavy. You would see cement being pretty heavy, industrial and capital goods being pretty heavy. Equally importantly, what you'd see missing is FMCG was zero in the last published portfolio. Metals was zero in the last published portfolio. So you'll see that there are significant sector skews in the portfolios we construct based on our view of the economy.
Got it. Um, just wondering, before we talk about the composition, and we may not talk about exact names, and which is fine, but maybe we'll do that on the other side of this break. But just one quick follow-up question to this, which is what are the key risks to your mind for almost any portfolios that you might be running, Anish, and specifically for a portfolio which is kind of taking advantages or playing according to business cycles?
Well, obviously, look, if we read the cycle wrong, right?
No, which is, sorry, Anish, sorry, let me rephrase my question. I'm not asking about generic risks, but the risks in the current business environment, sorry.
Oh, in the current business environment. See, I think obviously there are geopolitical risks which we need to keep a watch on. But apart from the geopolitical side of things, right? Actually, economies not just in India but even in other markets are looking reasonably good. US economy is actually booming. If you look at the US data on the labor market side, unemployment is at near 50-year lows. There are 1.5 vacancies for every one unemployed worker. So the US economy is booming, right? If anything, they're having to deal with excess demand. Europe has a little bit of problems, but relative to their own history of unemployment, they are also at relatively low unemployment levels. And China is going through a period of transition. We are not that negative on China. We actually feel that Chinese economy will recover. It's probably bottoming out. They're going through a period of transition from being real estate dependent to shifting demand to other sectors. Uh, that is a process that is painful, but it will happen over time. So I think the biggest risk right now is geopolitics. It's not the standard economic risks. We don't see huge excesses which should burst anywhere in the global economy, apart from the geopolitics.
Okay, interesting. Now, the point is we'll try and correlate that with the kind of investments that this fund has made. And Anish, I would love to understand within the parameters that you laid out, where is it that you have the largest overweight on currently?
Large overweights, actually three sectors. Right? Large overweights are in automobiles, industrial and capital goods, and cement. We normally at this point of the cycle would have also liked financials, but our view was that while there will be good demand in the financial sector, competitive intensity, at least amongst the lenders, which is banks and lending and NBFCs, was very, very high. So we've avoided banks and lenders. We do have insurance companies and asset managers, right? So in financials, if you look at financial intermediaries, we have insurers and asset managers, and then we have discretionary sectors like automobiles, cement, and capital goods.
Interesting. So non-lending financials have a very large share. Now, is it, they haven't done very well relative to maybe the market as well for a long time now. What makes you confident that there could be a turn?
Well, actually, asset managers have fared quite well, and some of the insurers have as well, particularly relative to banks. Our view is that if the economic cycle remains strong, then what we should see is, the total pool of savings and the total pool of people looking to deploy those savings in capital assets, right, like factories, houses, will increase, right? Because when you have more incomes, you save more, and those get invested. So the role of financial intermediation increases as the cycle recovers. And asset managers and insurance companies, we think, are very well placed. Banks will also see good demand, but the competitive intensity is capping sort of the profitability there.
Got it. So just a follow up there, sorry, before I come to the other sectors. There is a thought of people who look at, compare what's happened in different countries wherein per capita has moved up and what could happen in India too. And one of the themes that comes up is asset managers of all sorts doing very well over a 10-15 year period simply because discretionary demand will be invested. I would love to understand, do you think Indian financial institutions which are into asset management, wealth, etc., have that longer runway, and could it be as powerful a runway as we might have seen in some of the other economies?
Yeah, so this is a good point, and I should clarify this, right? The fund focuses on the cyclical aspect of the economy. We don't typically like to take 10-year views or 20-year views,
okay,
right? That's a structural view of the economy, right? Now, we do know, having said that, right, if the economy does well over a 10-year period, overall the financial sector will grow, right? But I would not know which way, whether people, households and firms will choose banks as the intermediary or asset managers as the intermediary or insurance companies as the intermediary. That we will see as things develop, right? How the regulatory landscape changes. Frankly, it depends on preferences of households, right? You might choose to, we don't know, Indian households might choose to keep all their savings in banks. They might choose to move more of their savings to asset managers. That will depend on the regulatory landscape, what kind of competitive market exists. And we don't like to take a 10-year view, right? We would focus on the 2 to 3 year view to see how things are changing and adjust the view as things go along.
Fair point. Thanks for that clarification. In the portfolio positioning currently, and I'm talking about the sectors, if I'm not wrong, the interesting thing that I saw was that construction and cement at 7 and 5%, much higher than industrials at 3%. I'm just trying to understand, are you trying to play the capex theme via construction and cement in some fashion, and why is industrials so low relative to the other two? Just trying to.
No, industrials is certainly not that low. I think some of the companies are getting missed out in the grouping that you've captured there.
Okay.
So industrials and capital goods and well, it depends on some companies can be classified as construction more or industrials and capital goods more. But I think it's better to aggregate the two and therefore look at it.
I get your point. Okay.
And that's pretty decent.
Fair point. The other aspect is automobiles. 12%, I would presume, and correct me if I'm wrong, is a relatively high weightage to the index weightages. Now, why is that the case? Because it's not that autos have had a bad run. You're coming off a decent base of performance as well on the last 2-3 years. So why such optimism? And what within this auto landscape do you like more? Because it's a very varied landscape, including auto components.
Yeah. So, firstly, see, the portfolio gets built over time and it changes gradually.
Sure.
So some of these auto positions that we built when they were obviously much cheaper.
Got it.
Now, how do we think about the exits is an important question. So when we feel that, look, earnings downgrades, right? Expectations have just become too high and earnings downgrades are more likely than earnings upgrades. That's the point in time we would like to trim. When I start building the portfolio, right, I feel, look, we take a view that, look, things are cheap, cycle is turning, but we really don't have a perfect idea of when the cycle will peak, right? How far it will run. That idea evolves over time, and we continuously monitor things to say, look, have we got to a point where now we are really having to stretch assumptions to come up with an upside, right? We are really having to stretch things, or are expectations still reasonable and could get upgraded? If we reach the latter view, we'll hold on to the call. So to your point, yeah, they may have done well in the past, but if our view is that, look, we might still get earnings upgrades, we'll hold on.
Is that the view currently for autos?
Yeah, that is why they have the portfolio.
Yeah, no, I'm just wondering whether in the near term, I mean, maybe there right now, but you might be changing your view post the results, so which is why I was wondering, you still think there is a case for earnings upgrades? Because we did hear one large auto ancillary give this warning around how growth is looking shaky both in India and global. Essentially, I'm talking about Baba Kalyani. I'm not referring to that stock per se, but just that commentary that came in from them. So, but you still believe the earnings downgrade case is not being built in autos currently?
We don't think that that's the more likely scenario.
Fair call, fair call. Just wanted to get that clarity as well.
And our thesis is more about domestic growth, right, rather than export. So we should also distinguish that. So we are more positive for autos, more positive on the domestic economy than on necessarily on the exports.
Got it.
We're not negative on exports, but the positivity comes more from domestic.
And that was going to be my last question, Anish. A global fund which looks at global cyclicals as well might be interested, for example, in metals, oil, mining, etc. Are you currently completely averse to that because the global economy is looking, for lack of a better word, a bit more shaky than what the domestic economy is?
So let's focus on metals. Metals we have in the published portfolio. You can see we have nil exposure. And the thing that matters for metals is not so much the global economy, but the Chinese economy. So for most metals, China is 50% of global demand. And our view on the Chinese economy is that it's going to transition away from a very metals heavy, like infrastructure, house building kind of activities, to other service oriented activities, which will use less metals. And if you say, look, 50% of demand comes from China and that demand is going to be weak or declining, it's very difficult to get positive on the overall metal stack.
Got it. Got it.
But I'm not saying that metal stocks are expensive. I understand they're cheap. But our view is, as I said, right, is earnings upgrades or downgrades, we feel the upgrades risk is lower. The chance of upgrades are.
Yeah. Point well taken, and thanks for filling up that blank as well. But Anish, it was so good talking to you. Time will always be less, but television compulsion, so we'll have to wrap it up here. But much appreciate your time and your insights. Thank you so much.
Thank you very much, Niraj. Real pleasure talking.
Yep, likewise. And viewers, thanks for tuning in to this leg of the Portfolio Manager.